There is a profound and terrifying cognitive dissonance echoing through the global economy right now, and it is driving millions of hardworking people to the brink of absolute financial exhaustion. You turn on the television or you open a financial application on your phone, and you are bombarded with flashing green numbers. The talking heads on the financial news networks are celebrating. They are pointing to the major stock indices, brushing against all-time highs. They are talking about the unstoppable resilience of the consumer, and they are declaring that we are in the midst of a historic economic boom. You see headlines about new technological revolutions, artificial intelligence billionaires, and a stock market that seemingly refuses to go down. But then you turn off the television and you walk out your front door into the real world. You go to the grocery store and you look at the receipt in your hand, wondering if there has been a mathematical error. You look at the property taxes on your home or the monthly rent for a modest apartment, and you feel a tightening in your chest. You look at the cost of insuring your vehicle, heating your house, and providing basic medical care for your family, and you realize a chilling truth. Despite the flashing green numbers on Wall Street, you are becoming poorer every single day. I have spent the better part of 8 decades analyzing the architecture of wealth, the cycles of human psychology, and the fundamental laws of financial gravity. I am telling you today with absolute certainty that you are not imagining this disconnect. You are not failing because you lack discipline, and you are not falling behind because you bought a cup of coffee on your way to work. You are experiencing the brutal mathematical reality of what I call the fake bull market of 2026. The institutions that govern our money have executed a structural redesign of the global economy, and if you do not understand exactly how the rules have been rewritten, you are going to be completely wiped out. The financial strategies that guaranteed a comfortable, secure life in the late 20th century, or even 5 years ago, are actively toxic today. If you continue to play by the old rulebook, you are walking blindfolded into a buzzsaw. Today, we are going to have a deeply uncomfortable conversation. I am going to tear down the mirage of the modern economy. I am going to expose the exact mechanics of the fake bull market, and I will reveal the 4 devastating financial traps that have been engineered to keep you functioning as a highly productive, heavily indebted gear in a machine that enriches someone else. And then, I am going to give you the blueprint. This is the exact, unyielding mathematical protocol that the truly wealthy are using right now to shield their fortunes from the coming storm, build impenetrable fortresses of liquidity, and multiply their net worth while the rest of the world is seduced by the illusion. This will be a massive, demanding, and unapologetic masterclass. It requires you to abandon your ego, silence your emotions, and look at your balance sheet with cold, clinical objectivity. But if you have the discipline to stay with me until the very end and the courage to execute the protocol I am about to share, you will completely rewrite your financial destiny and build an empire that cannot be confiscated. To understand the fake bull market, you must first understand the great illusion of nominal pricing. For decades, the middle class was told that if the stock market goes up, the economy is healthy and wealth is being created. In 2026, we are living through the consequences of an unprecedented global expansion of the fiat money supply. Governments around the world have taken on staggering, incomprehensible levels of debt. The U.S. national debt has exceeded $34 trillion. UK government debt has surpassed £2.6 trillion. Debt to GDP ratios in most developed nations are at levels that would have been unthinkable a generation ago. When governments have too much debt, history shows they rarely pay it back honestly. Instead, they inflate their way out. They allow the currency to lose value so that the debt becomes easier to manage. The US dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. The British pound has followed a similar trajectory.
When a central bank prints trillions of units of currency out of thin air to buy government debt, they do not create a single ounce of new wealth. They simply dilute the purchasing power of every single unit of currency that already exists. It is the inescapable physics of supply and demand. Inflation over the past 4 years has cumulatively exceeded 20% in both America and Britain. That means if you had $100,000 in 2020, the purchasing power of that money has dropped to approximately $80,000 in real terms. You didn't spend it, you didn't invest it badly, you just let it sit there being responsible, and you lost $20,000. Here is where the illusion traps the masses. When the currency loses its value, the nominal price of hard assets goes up. If the dollar loses half its value, it requires twice as many dollars to buy the exact same share of a business, the exact same acre of farmland, or the exact same house. The stock market hitting all-time highs is not necessarily a reflection of businesses suddenly becoming exponentially more productive or innovative. In many cases, it is simply a reflection of the currency becoming exponentially weaker. You are measuring your wealth with a yardstick that is shrinking by the day. If your stock portfolio goes up 10% in a year, but the true cost of living, the cost of energy, food, housing, and healthcare, goes up 15%, you have not made money. You have lost purchasing power. You are bleeding out slowly, comfortably, and quietly while the financial media tells you to celebrate. This is the macroeconomic reality of 2026. You cannot vote it away, you cannot complain it away, you can only adapt to it. And to adapt, you must recognize and brutally purge 4 specific, devastating traps from your life. The first trap is the illusion of absolute safety in fiat currency. The greatest financial sin of the 2020s is the belief that cash is a safe long-term investment. The financial industry loves to sell you the illusion of the high-yield savings account. They proudly offer you a 4 or 5% return on your money, and you feel brilliant for taking advantage of it. You log into your account, you see the interest payment deposit, and your brain releases a hit of dopamine. You believe you are acting responsibly because the number on the screen never goes down. But you must look at the math. If your bank pays you a fixed yield and the real rate of inflation is rising faster than that yield, your safe investment is generating a guaranteed negative real return. You are paying the bank a fee every single year for the privilege of holding your money while it evaporates. Cash in a savings account is not an asset. It's a temporary parking spot that's leaking value every day. The wealthy do not hoard cash as a long-term investment. They understand that fiat currency is a melting ice cube. If you leave it sitting in the sun, it will disappear. They view cash purely as a logistical tool. It is a temporary holding tank used to facilitate daily transactions, and it is a strategic reserve of ammunition waiting to be deployed when the market crashes and presents a generational buying opportunity.
To survive the fake bull market, you must transition your mindset from a hoarder of depreciating paper to an accumulator of appreciating hard assets. You must own things that central banks cannot print. Real assets are ownership stakes in productive enterprises. When you own shares in a company, you own a piece of a business with employees working every day to create value. You own equipment, inventory, intellectual property, customer relationships. These real assets tend to hold their value and grow even when currencies decline. Let me be absolutely clear, because this nuance is where many people fail. You must maintain strategic liquidity for opportunities and emergencies. I always keep cash available, even though I know it loses purchasing power over time. Not because I love holding cash, because cash gives you options when others have none. In every market downturn, the best buying opportunities appear. Great businesses go on sale. Assets that were expensive become affordable, but you can only take advantage if you have available capital. I recommend maintaining at least 6 months of essential expenses in highly liquid form, not invested, not tied up in assets that could take months to sell, available immediately. This isn't money you're investing, it's insurance. It's buying power for emergencies and opportunities. It's what allows you to stay calm when everyone else is panicking. Yes, this cash will lose some purchasing power to inflation. That's the cost of security and optionality. It's worth paying. But anything beyond that absolute shield must be sent out into the world to work for you. It must be converted into ownership. The second trap is the blind worship of extreme overvaluation. The most dangerous moment in investing isn't a crash, it's confidence. Right now, markets are characterized by extreme confidence, complacency, the belief that stocks always go up. FOMO is everywhere, fear of missing out. People buying because they can't stand watching others make money. Because the average person feels the agonizing pressure of inflation, they become desperate to catch up. They see the market hitting record highs and they blindly throw their capital into equities regardless of the price. They divorce price from value, which is the exact moment investing turns into gambling. You must look at the cold, hard mathematics of the market today. The S&P 500 is trading at valuations that have only been exceeded twice in history, once during the dot-com bubble, once during the 2021 peak. Both times were followed by significant pain for investors who bought at those levels. The current price-to-earnings ratio of the S&P 500 sits around 27 to 28 times earnings. The historical average is closer to 16. That means stocks are roughly 70% more expensive than their long-term average. Imagine you're buying a house. The house normally costs $300,000, but today the seller wants $500,000. Same house, same neighborhood, same everything. Would you pay that premium just because everyone else is bidding, or would you wait for sanity to return? That's exactly the situation in stocks right now. The Shiller-Cape ratio, which adjusts for inflation and uses 10 years of earnings to smooth out cycles, is currently hovering around 35 to 37. This level has only been exceeded once during the dot-com bubble peak in 2000. After that peak, the S&P 500 took over a decade to return to its previous highs. Investors who bought at the top in 2000 didn't break even until 2013. 13 years of waiting, 13 years of zero returns, all because they bought when prices were irrationally high. Furthermore, market concentration has reached dangerous levels. The top 10 stocks in the S&P 500 now represent nearly 40% of the entire index. This is unprecedented. When you buy an S&P 500 index fund today, you're not getting diversification, you're making a massive bet on a handful of technology companies. If those companies stumble, the entire market stumbles. And many of these companies are trading at 50, 60, even 80 times earnings. When you buy a stock trading at 30 times earnings, you're paying for decades of growth up front. If that growth doesn't materialize exactly as expected, you lose money even if the company does well. I want to buy wonderful companies when they're priced like average companies. That happens during corrections, during recessions, during periods of market panic. This is exactly when I sell, not when I buy. I buy when there's real fear, when headlines are screaming about crash risks, when your coworkers are abandoning the market, when investment feels terrifying rather than exciting. The VIX Volatility Index, often called the fear gauge, is currently sitting at relatively low levels, below 15. During periods of genuine fear, the VIX spikes to 30, 40, sometimes above 50. I want to see that spike. I want to see panic because panic creates opportunity. During the March 2020 COVID crash, the VIX hit 82. Markets fell over 30% in weeks. Headlines predicted the end of the economy. That was the perfect time to buy. While headlines celebrate record highs, I'm doing the opposite. I'm holding more cash than ever in Berkshire Hathaway's history, over $330 billion waiting. That isn't fear, that's discipline. You don't raise this much cash when prices make sense. When the S&P 500 price-to-earnings ratio drops to 20 or below, I start getting interested. When it drops to 15 or below, I get excited. Until value emerges based on conservative estimates of future cash flows, patience pays and impatience costs. The third trap is the normalization of indenture through destructive leverage. We live in a society that has normalized financial servitude. The marketing apparatus of the global economy is designed to make you feel inadequate and then offers you a credit card, an auto loan, or a buy now, pay later scheme as the magical cure for that inadequacy. The middle class has been trained to completely ignore the total cost of an item and focus exclusively on the monthly payment. This is the architecture of permanent poverty. When you finance a depreciating asset, a luxury car, a vacation, a designer wardrobe, at exorbitant interest rates, you are mathematically destroying your future. You are taking the finite, precious hours of your future labor, hours you have not even worked yet, and you are volunteering to give them to a global financial institution simply because you lacked the discipline to delay gratification. Compound interest is the absolute law of financial physics. When you invest, compound interest builds empires. When you borrow for consumption, it builds prisons. The average credit card interest rate in America right now is over 20%. In the UK, it's between 18 and 25%. The stock market has historically returned around 10% annually over the long term. If you're paying 20% on debt while investing at 10% returns, you're losing money. Every pound you put toward investments while carrying credit card debt is a pound that would work twice as hard paying off that debt. You cannot out-invest high-interest debt. Don't even try. Eliminate it first, then accelerate your investing. The wealthy view consumer debt with absolute visceral disgust. They use credit cards strictly for security and convenience, paying the balance in full every 30 days. If you are financing a lifestyle you cannot afford in cash in 2026, you are not a consumer. You are the product being consumed by the banks. You must declare absolute, uncompromising war on your consumer debt. Attack it with fury. Sell things you don't need. Cut every unnecessary expense until that debt is gone. The fourth trap is the friction of hyperactivity and complexity. Human beings are terrible at making consistent financial decisions. We're emotional, we're easily influenced, we get tired and distracted. Every study of investor behavior shows the same pattern. People buy high and sell low. They chase performance. They panic during downturns. They get greedy during bull runs. They underperform the very investments they hold because they can't sit still.
The financial industry profits when you move money around. When you're scared, they sell you products. When you're greedy, they sell you products. Most financial media exists to generate clicks and views, not to actually help you build wealth. It keeps you engaged, confused, and dependent on their next piece of content. It keeps you trading, which generates commissions. Furthermore, Wall Street is very good at creating products that sound like solutions. Options trading, leveraged ETFs, structured notes. Anything that comes with a glossy brochure, a clever name, and a payoff diagram that looks like a carnival game. If you can't explain how something makes money, you're not investing, you're trusting, and trust is not a strategy. Complexity increases the chance you'll be surprised. High-fee products quietly extract a percentage forever. If you have $500,000 and pay 1% annually, that's $5,000 a year leaving your account. The real cost isn't just the fee, it's the growth you will never earn on the money that left. Activity isn't progress. Often it's the opposite. The best investors make very few decisions, but the decisions they make are carefully considered and held for decades. In my entire career, I've probably made 20 investment decisions that really mattered. 20 decisions across 70 years. The rest was noise. We have identified the traps of the fake bull market, the hoarding of paper, the blind worship of overvaluation, the servitude of consumer debt, and the friction of complexity. Now, we must administer the cure. If you want to survive the wealth transfer of 2026, you must adopt the architecture of accumulation. This is the exact, unyielding protocol that separates the permanent ownership class from the permanent renter class. Phase 1. The ruthless expansion of the gap. Wealth is created in the margins. The foundation everything else depends on is spending less than you earn by a significant margin. The average American household earning $70,000 annually saves approximately 3 to 4% of their income. That's about $2,000 a year. Wealthy households operate completely differently. They maintain savings rates of 20, 30, even 50% of their income, regardless of how much they earn. The gap between income and spending isn't something they think about occasionally, it's engineered into their lifestyle permanently. You must attack this gap with relentless aggression. Ruthlessly examine your spending. Cut everything that doesn't genuinely improve your life. Redirect that money toward protection and growth. Live far below your means. I still live in the same house I bought in 1958 for $31,500. Every dollar you spend is a dollar that can't work for you. Every purchase trades present consumption for future wealth. Find ways to increase that gap by at least 10% immediately. Cut subscriptions you don't use. Reduce housing or transportation costs if possible. Phase 2. The systematic execution of automation. You cannot rely on willpower to build wealth. The solution is automation. Set up automatic transfers from your checking account to your investment accounts on the day after you receive income. Choose your investment allocations once based on principles, not predictions, and then automate the purchases. Create systems that execute your plan regardless of how you feel on any given day. The wealthy don't have superhuman discipline. They have systems that make discipline unnecessary. The money moves before they can talk themselves out of it. The plan executes automatically, month after month, year after year, decade after decade. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices, an S&P 500 fund, a total stock market fund, or a global equity fund. Keep it simple. Complexity is the enemy of execution. You simply need to own pieces of many businesses and hold them through all conditions. Let the system do what you designed it to do. Phase 3. The lifelong construction of the intellectual moat. The single greatest, most productive asset you will ever own does not have a ticker symbol on the New York Stock Exchange. It is your own mind. I read every single day for hours. This isn't casual reading. This is 5 to 6 hours of focused reading daily. Annual reports, financial statements, newspapers, books, anything that expands my understanding of how the world works. This habit compounds like interest. Every day I go to bed a little smarter than when I woke up. Over decades, that daily improvement becomes an enormous advantage. Charlie Munger, my partner for decades, said something that stuck with me. He said he's never known a wise person who didn't read all the time, not one. Protect your first hour of every day like your wealth depends on it, because it does. No phones, no emails, no news, no reactive behavior. Use this time for reading, planning, exercise, thinking, high-priority work that requires full cognitive capacity. I spend a significant portion of my day just sitting and thinking. No phone, no distractions, just me and my thoughts. I protect empty space because that's when insight happens. If you learn something new each day, after 1 year, you've accumulated 365 new insights. After 10 years, that's over 3,600 insights. Understanding compounds. Wisdom accumulates. Develop a high-value skill. The market doesn't pay you based on how hard you work. It pays you based on how much value you create and how replaceable you are. If you have rare, valuable skills that companies desperately need, you can command almost any salary you want. The era of easy money is over. The fake bull market is a siren song designed to lure the impatient onto the rocks. The comforting illusion that a simple savings account, a massive mortgage, and a generic degree will guarantee a safe, prosperous retirement has been completely shattered. But you do not have to be a casualty of this great economic shift. The rules of wealth creation are not a closely guarded secret hidden in a vault. They are simply unpopular because they require immense discipline, extreme sacrifice, and the willingness to look entirely foolish to your broke neighbors in the short term. You must take radical, uncompromising responsibility for your own balance sheet. No politician is going to ride in on a white horse to rescue you. No central bank is going to engineer a monetary policy that suddenly makes you rich without effort. The rescue operation begins and ends with the person looking back at you in the mirror. Audit your expenses tonight with a red pen. Kill your consumer debt as if your life depends on it. Build your defensive perimeter of cash until it is impregnable. Wait patiently for the true mathematical value of assets to reveal themselves through fear and market panic. Direct every single surplus dollar into the automated ownership of productive, cash-flowing global businesses, and then have the unbreakable stoic fortitude to sit in an empty room, read a book, and let time and mathematics do the heavy lifting for you. The path to absolute financial sovereignty is boring, it is remarkably slow, and it is absolutely guaranteed to work if you simply refuse to quit. Which side of history will your balance sheet be on?